Hey, this is Brent from Wolf on Wall Street Trade. It is November 22nd, 2018. It's Thanksgiving. I'm having a mimosa and getting ready to go spend some time with the family. And I imagine the topic of conversation this year is going to be what the hell is going on with the stock market. So I thought I would try to do a quick 5-minute video. I haven't done a video in 10 years, so bear with me. What I have is a monthly chart of the S&P 500 in this top window up here. So each one of these candlesticks is 1 month, and I have a long-term chart of the 10-year yield, and I've drawn some trend lines in. So you can see going back, this is 1979, this is 2000, so on and so forth. So what I think the market is missing, or has been missing, especially in 2018 more than anything, is that we are late in the economic cycle or the debt cycle. And for the purposes of this video, I'm going to define the economic cycle as these oscillations, or the debt cycle as these oscillations within this downtrend. So over here we have yields going down. Okay, this is in response, usually in response to some kind of a crisis. Yields go down and they try to stimulate the economy. And then when they move up to the top of this channel, that's relatively higher. It's not as high as it was back here in the 1980s, early 1980s, but it's relatively higher. And watch what happens. That is the 1987 stock market crash. So yields move down and then they move up, relatively higher. Debt becomes more expensive. And what we have here is the 2000 dot-com bubble or top, and the market came down, went to a bear market, the economy went into recession. Yields went down, again up to the top of this channel, and what we have here is 2007, 2008, the financial crisis, subprime mortgages, all that. Again, yields went down, rates went down to the lower part of the channel. The Fed actually put the reserve rate down at 0, and now that hasn't happened since 1929 to 1932 in that period, and that kind of defines this longer term debt cycle where rates have gone from high to really rock bottom at 0 for 7 years, and now they're starting to move up. So if we take a closer look at the market in 2018, I'll show you what the market really missed. Now this is a daily chart of the S&P 500 and the 10-year yield. And here you can see October, November of 2017. The market is just rallying. It's in all-out melt-up mode. And when that happens, the market becomes inefficient. Everybody's looking the same way. They're not looking at things that could be potential problems. And one of those potential problems that I was banging on the desk about for members at the end of 2017 was the fact that yields were breaking out above this long-term trend line. And that's the trend line I just showed you on the monthly chart. They were breaking out above that, and the market was not paying attention. And here you have the February sell-off as yields were spiking. Then the market finally said, oh, look at this, yields are going higher. We're starting to get concerned, and the market sells off. Now, yields kind of, they did make another high here in May, but then they consolidated. And then in September, the same thing started happening again. Now, keep in mind, as the U.S. market is rallying here through the summer, global markets are selling off, China's selling off, emerging markets selling off, and it's just kind of the U.S. and it's like trade wars. Oh, that's fine, you know, buy everything, buy stocks. Again, the market was becoming inefficient, not paying attention to things it needed to pay attention to. And what you'll probably remember is I started pounding the table again in September and saying, look, yields are a big deal. Rates are becoming a big deal. The market is missing it. The market's rallying here. There were other things going on, but this is the biggie. So yields came up to a new cycle high right here. They consolidated, and watch, when they break out above that consolidation, that's when the market started selling off again. So that is really what has driven both sell-offs this year, the one in February and the one in October. Yields, there are other things that are cropping up now, but now the market is getting inefficient again. It's in bear mode now, and everything is bad news at this point. What's important to understand at this point is where we are in the short-term debt cycle and even the long-term debt cycle, and the fact that when rates go from relatively low to relatively high, it causes stress on financial assets, as we saw in 2000, as we saw in 2007, 2008, and as we are seeing right now in 2018. So I hope you enjoyed the video. Maybe I'll do some more. Have a fantastic Thanksgiving.